profit relationships, also known by its initials, CVP. Our first objective here is to compute the contribution margin ratio, and the unit contribution margin, and explain how they may be useful to managers. Now, before you start this, you should have a good understanding of what is a variable cost, what is a fixed cost. And in Chapter 3, we also studied mixed costs and how to divide them out, because in CVP analysis, we need only variable and fixed costs. We can't deal with mixed costs. So you have to first get your mixed cost down into variable and fixed before you go forward. Cost, volume, and profit are three different things. Cost are the costs that we incur for the products. Volume is how many are we selling of the products. And profit is our operating income. So once we subtract our costs from our revenue, what is left over for income from operations, also known as operating income. And so we're going to study the relationships between all of those things, between sales and selling prices, costs and expenses, production volume, meaning how many are we making and selling, and the profits that we're getting. Management needs to be able to understand all of those relationships so that they can be able to answer questions and to make decisions. The contribution margin is the excess of the sales over the variable costs, only the variable costs, not all the costs. Okay, it contributes first toward covering the fixed costs. Whatever's left over after we subtract variable costs, that's the amount that can be applied to fixed costs. And then if there's even still some left over, that's what is our profit. So here shows you a contribution margin income statement. We're used to the regular income statement for GAAP. That is sales minus cost of goods sold, which is the costs of the factory, the cost of building the product, and that gives us gross profit. Then we subtract out the period costs, the cost of the office, and that gives us income from operations. Now here, we're just taking the costs and we're divvying them up a different way. And we also talked about this back in Chapter 3, if you want to review over Chapter 3 again. Here, instead of cost of goods sold and operating expenses or period expenses, we have variable costs and fixed costs. So these variable costs include all the variable costs from the factory and variable costs from the office. And these fixed costs, again, include all fixed costs from the office, fixed costs from the factory. So if we take our sales minus all of our variable costs, that gives us something known as contribution margin. Then from that, we subtract fixed costs, and that gets us income from operations, also known as operating income. Okay, we can also calculate out a contribution margin ratio. Just like we took gross profit and divided it by sales to get a gross profit percentage, here we can take our contribution margin and divide it by sales, and we'll get a contribution margin ratio. So our contribution margin ratio here, our sales of $1 million minus our variable costs of $6,000, that gives us our contribution margin of $400,000. That's on our numerator. And we divide that then, that $400,000 divided by sales, which is $1 million. And so that gives us 40%. The contribution margin ratio is shown as a percentage. We can divide each number by sales and get its percentage. However, the contribution margin ratio is a primary number that we can use in other formulas. We also will look at the unit contribution margin in several formulas, and this basically is the sales price for 1 unit less or minus the variable cost for 1 unit, gives us the contribution margin for 1 unit, also known as the unit contribution margin. So here we have the same million minus the 600,000, 400,000. We still have the same total amounts over here. But if we know that that was 50,000 units that were sold, I take the million divided by 50,000 units. That tells me my sales price was $20 for each unit. The 600,000 divided by the 50,000 units, my variable cost is $12 per unit. 400,000 divided by the 50,000 units is $8, or I can take the $20 minus the $12, and that equals $8. So we may already have the sales price and variable cost per unit, contribution margin per unit already. If we don't and we only have these totals, then we just have to know how many units and we can get to those per unit amounts. Now here, once we have these per units amounts, it's easy for us to then figure out, if we're the manager, okay, we made $100,000 operating income when we sold 50,000 units. What if we can sell 15,000 more units? How will that change our operating income? So now I'm going to take the 65,000 units, multiply it by the $20, and that gives me 1,300,000 in sales. I'll take the 65,000 units times the $12 variable cost, and that gives me 780,000. I can take the 1,300,000 minus the 780, or I can take 65,000 times 8, either one will give me the 520,000, the contribution margin. Then my fixed cost of 300,000, of course, that stays the same. Okay, so I subtract the 300,000, and that gives me 220,000 of operating income. So notice that by selling 15,000 more units, I can more than double my operating income. So in this case, if we can do some kind of advertising, or we can do some special things to draw in more customers to buy those 15,000 extra units, that will more than double our operating income. So here we're showing that we can express the contribution margin in 3 different ways. We first can show the total contribution margin in dollars, which is our total sales minus our total variable cost equals our total contribution margin. Or we can show it as the contribution margin ratio, which is the contribution margin divided by sales. That gives us the 40%. And our third way is to do it by the unit contribution margin, which is to take the sales per unit minus the variable cost per unit, gives me my unit contribution margin. Let's take a look at an example. Molly Company sells 20,000 units at $12 per unit. The variable costs are $9 per unit, and fixed costs are $25,000. we need to determine A, the contribution margin ratio, B, the unit contribution margin, and C, the operating income. So here are our answers for the contribution margin ratio. We have the contribution margin, which we can either do by the per unit $12 sales minus $9 variable cost. That'd be $3 on our numerator divided by our sales price, which is 12, and that will give us 25%. Or we can use the totals, the total sales of 240,000 minus 180,000 total variable costs. That gives us $60,000 on our numerator divided by 240,000 sales, and that will also equal 25%. So we can do it either way and come out with our contribution margin ratio of 25%. Our unit contribution margin is the $12 sales price per unit minus the $9 variable cost per unit equals our unit contribution margin of $3. Our total contribution margin is our total sales, 240,000, minus our total variable cost of 180,000, and that equals 60,000. Then if I take that total contribution margin of 60,000 and I subtract out my fixed cost of 25,000, I get 35,000 operating income. Using the unit contribution margin, we can determine a break-even point and the volume necessary to achieve a target profit. So this is our second objective, is to be able to figure these break-even points and target profits. And managers utilize this a lot, especially if they are either just starting a business or they're looking at adding a new type of product line to an existing business. Then they really do a lot with this on paper before they make a bunch of contributions of money into this effort, and maybe it won't be able to break even, or maybe it won't be able to achieve our target profit. So what is the break-even point? That's the level at which our operating income will be zero. All the revenues minus all the costs, both variable and fixed, equals zero. Okay? And we can look, when we look at this break-even point, we can see how many units do we need to sell to break even so that our revenues equal our expenses, our costs. Or we can also look at how many sales dollars do we need to break even. So here's an example. Barker Corporation's fixed costs are estimated to be $90,000. The unit contribution margin is calculated as follows. Our selling price is $25 per unit minus our variable cost, which is $15 per unit. That gives us our unit contribution margin of $10. So our contribution margin ratio would be the unit contribution margin divided by the selling price. 10 divided by 25 is 40%. So we know our unit contribution margin at $10 and our contribution margin ratio of 40%, our fixed cost of $90,000. So when we're looking at break even in number of units, we're going to use this formula here. We're in the numerator, we're going to put our fixed costs, and in the denominator, we're going to put our unit contribution margin. So our fixed costs in this case were $90,000, and our unit contribution margin was $10. So 90,000 divided by $10 is 9,000 units. We need to sell 9,000 units and we will end up breaking even. Now, if we're the manager, we have to ask ourselves, do I think I can sell 9,000 units? Okay. And if I don't think I can sell 9,000 units easily, then this is not a product line we want to get involved in. If we say, oh, yeah, we should be able to sell at least 50,000 units, the break even won't be a problem, then this would be something that we would further investigate. Now, another way to look at break even is in sales dollars. So we have a slightly different equation for looking at break even in sales dollars. We still have the fixed costs on the numerator, but on the denominator, instead of the unit contribution margin, we're going to use the contribution margin ratio. So here we have the fixed cost of 90,000 on the numerator, but on the denominator, instead of the $10, we're using the 40% contribution margin ratio. So 90,000 divided by 40%, or 0.4, is 225,000. So we need to have $225,000 in sales to be able to break even. So here is where we can see that we're looking at proving that we're right, okay? So our sales price per unit was $25. We multiply that times, we said we'd have to sell 9,000 units to break even. So 25 times 9,000, that gives us $225,000 in sales, which we also had calculated out. Our break even in sales was 225,000. Okay, then we need to do our variable costs. Our variable costs were $15 per unit times our 9,000 units we need to sell to break even. That's 135,000. If I take a 225,000 sales minus 135,000 variable costs, that gives me contribution margin of $90,000. I have fixed costs of 90,000, so my 90,000 contribution margin minus my 90,000 fixed costs equals 0 operating income. So this proves that by doing 9,000 units, selling 9,000 units, or selling 225,000 in sales, I will come up with a break-even 0. Okay, this slide is just telling us that if either the fixed or the variable costs go up, if our costs go up, then our break even, how many units we have to sell, will also have to go up, because our profit will be lower. And so to get it to 0, we're going to have to sell more units. Okay? If our fixed or variable costs go down, then our break even will go down. So if we can figure some way to reduce our fixed costs or our variable costs, then we won't have to make quite as many units to sell to break even. Here's an example showing increase in fixed costs. So Bishop Company is evaluating a proposal to budget an additional $100,000 for advertising. Fixed costs before the additional advertising are estimated at $600,000, and the unit contribution margin is $20. Okay, so right now we're spending $600,000 on advertising, and that's a flat fee we're spending. It's not a we spend so much for every unit we sell. We spend a flat $600,000, so that's a fixed cost. We're thinking about selling advertising, doing an extra $100,000. So we'll have a total of $700,000 of fixed costs of advertising. Okay, our unit contribution margin is $20. So without the additional advertising, meaning right now, we have fixed costs divided by our unit contribution margin, and our fixed costs right now are $600,000 divided by our $20 unit contribution margin, and that's 30,000 units. We have to sell 30,000 units right now to break even. Now, what if we add the extra 100,000 of advertising? Now our fixed cost that it's on the numerator is now 700,000. We're still dividing by the $20 unit contribution margin. That gives us 35,000 units. So to pay for that extra 100,000 of advertising, we need to sell a minimum of 5,000 more units. So if we think the advertising will allow us to sell, say, 20,000 extra units, then this is a no-brainer. We should do this. If we think, well, it's kind of touch and go, if we put in the extra 100,000, it's touch and go whether we'll be able to sell the extra 5,000 units from that extra advertising, then we should not do it. Okay, what if we increase variable costs? Okay, here's an example here. Part company is evaluating a proposal to pay an additional 2% commission on sales to its salespeople. Okay, commission means the more sales I have, the more I have to pay the salespeople. So that's a variable cost. And we're doing that to provide an incentive to increase sales. Okay, fixed costs are estimated at $840,000. The unit contribution margin before the additional 2% commission is $250 sales price minus the unit variable cost of $145, and that gives us our unit contribution margin of $105. Now the new variable cost is going to be different because we have to pay this extra 2% commission on our sales. So for each sale, for each unit, we sell it for $250. So $250 times 2% commission is $5. Okay, so we're going to have an extra $5 of unit variable cost. So that'll be $250 minus $150, and that'll give us $100 contribution margin with the extra commission. Now here is without the additional 2% commission. This is what we're doing right now in units. Our break even is fixed cost divided by our unit contribution margin. That's our formula. Our fixed cost, we said, was $840,000 divided by currently the unit contribution margin is $105 before adding the extra commission. So $840,000 divided by $105 is 8,000 units is what we need to sell to break even. Now, what about if we add the extra 2% commission? Okay, 840,000 fixed cost divided by our new $100 unit contribution margin is 8,400 units. So we have to sell 400 more units to be able to break even. Now, again, the managers would say, okay, if we up the commission, the salespeople are all going to want their extra commission, so they're going to get out there and sell more. Can they sell 400 more units? If it's touch and go, then we're not going to do this extra commission. We'll just let it go. Otherwise, if we think, oh yeah, if we offer them the extra commission, for sure they'll sell, 2,000 extra units. And so then we would definitely go forward with that. Okay, here is showing you how we got the $100, the 250 sales price times the 2% commission. That's the $5. And that got added into the $145 that we already had to pay for variable costs. And we had the sales price per unit minus the variable price per unit of 150, and that gives us the unit contribution margin of 100. Okay, here's another example of break-in. Nicholas Enterprises sells a product for $60 per unit. The variable cost is $35 per unit. Fixed costs are $80,000. We need to determine a break-even point in sales units. And so we take 80,000, our fixed costs, divided by our unit contribution margin, which is our sales price minus our variable cost. 60 minus 35, that'd be $25 as our unit variable cost, unit contribution margin. So 80,000 divided by 25 is 3,200 units we would have to sell. Now, what if we want not just to break even, but we have a certain amount of operating income profit that we want to be able to show. Otherwise, we don't want to get into this new product line or whatever. Okay, and so we're just going to modify our break-even equation a little bit. So in units, we're going to take the fixed costs plus the target profit that we're wanting to make on the numerator. And our denominator is still the same, unit contribution margin. Okay, so all we've done is add the target profit up to the numerator. Okay, if we want to see what break even is for sales dollars, we will do the same thing. We're just going to add target profit up to the numerator. Our denominator is still contribution margin ratio. So here we have fixed costs are estimated at 200,000. The desired profit we want is 100,000. The unit contribution margin is $30, and our contribution margin ratio is 40%. So now we want to calculate out our break even. And we have our unit selling price of 75, unit variable cost of 45, unit contribution margin of 30. So this is how we got that 30. And we took the 30 divided by the 75. That's how we got the 40%. Okay. So our formula for units is the fixed cost plus the target profit divided by the unit contribution margin. So our fixed cost is the 200,000, and our target profit is the 100,000, and our unit contribution margin is this $30. Okay, so we have 200,000 plus 100,000, that's 300,000 on the numerator, $30 on the denominator, and so 300,000 divided by 30 is 10,000 units. We need to sell 10,000 units to break even. Now, let's take a look at the sales dollars. We still have the same information, only now instead of the unit contribution margin of $30 on the denominator, we're going to use the contribution margin ratio of 40%. So now I have the 300,000 divided by 40% or 0.4, and that gives me $750,000 that I need to sell to break even. And here's our proof, okay? If we use the 10,000 units we said we need to sell times $75, our sales price per unit, that's 750,000. That also equals our sales dollars that we had calculated. Okay, we subtract out our variable cost, 10,000 units times $45 variable cost per unit is 450,000. 750,000 minus 450,000 is 300,000 is our contribution margin. We subtract out our fixed costs, which were $200,000, and that gives us our desired target profit of $100,000. So we have proven that the 10,000 units or $750,000 in sales will provide us a target profit of $100,000. Here's another example. The forest company sells a product for $140 a unit. The variable cost is $60 per unit. Fixed costs are $240,000. We want to determine the break-even point in sales units and the break-even point in sales units if the company desires a target profit of $50,000. So first we're going to take the fixed cost of $240,000 divided by the unit contribution margin. That's the $140 sales price minus the $60 variable cost per unit. So that'd be $80. 240,000 divided by 80 is 3,000 units we need to sell to break even. Now, if we want to have $50,000 of target profit, we'll take our fixed costs of $240,000 plus our target profit of $50,000. We add those together. That's $290,000 on our numerator and the $80 on the denominator, and we get 3,625 units. So we need to